Welcome back to another Tax Talker. Another one for you on tax planning. Last videos we talked about safe harbor and what you need to pay, but how about how you can influence income? It's that time of year, right? Everyone's telling you about the deduction they're getting. Your friend's bragging about writing off his car, his vacation, the dog food. It's easy to feel like you're the only one in America actually paying income tax. But there's a whole lot of noise out there, and not all write-offs are applicable to you. Today we're breaking down what's actually deductible to you, what's relevant, and what you can ignore as wishful thinking or outright tax fraud. Let's get into it. When people talk about write-offs or deductions, usually there's two broad categories they're talking about. The first one is business or self-employment expenses. They either have a side hustle or their main business they own, or they're self-employed, and they're talking about the expenses associated with it that they deduct from revenues in arriving at net income. And they are correct. Anything that is ordinary and necessary to the earning of that self-employment income is a deduction. So if they are running a pet spa or even have a rover where they have dogs at their house, yeah, they probably could write off some dog food. The next category is tax preferential items. And if that sounds vague, it's because it is. These are all the items within our tax code, whether via a deduction from income or a credit against your tax liability, that reduce your overall taxes. And these apply to individuals regardless of business ownership. And classic examples of these are your retirement contributions or the mortgage interest deduction. It's important to consider these two categories broadly because they behave completely differently. If you are not a self-employed individual, then you really can ignore that first category. If you are self-employed, let's talk about that briefly. Business expenses. If you run a business or just have a part-time business where you're making some extra income, you can deduct the expenses, again, to use the IRS's phrase, that are ordinary and necessary to the business. And that doesn't mean that's always easy to tell. There's definitely gray area, especially around where personal expenses stop and business expenses begin. Examples where people think they're deductible where they're not are things like clothes you use for your job, unless it's a specific uniform that you would never wear outside of that. But just buying some clothes, maybe they're nice clothes, you wouldn't have bought them otherwise, but they're not unique to that business. That's not a write-off. Similarly, if you're driving to an office of some sort, that's commuting mileage. That's not business mileage, and that's also not a write-off. But there are plenty of expenses that are legitimate business expenses, or items that are mixed use. Think about a cell phone for an Uber driver. Even if they're working full-time, they probably should not write off the entire cell phone unless they legitimately have a separate phone for their personal use. But it is appropriate under the tax law to take that item, that mixed-use item, and come up with what's the percentage attributable to the business use. Very similar thing for a graphic designer who's in business for himself, who buys a very nice computer, but they're going to use it for both business and personal. You're going to want to come up with some sort of reasonable business percentage on that. Now, there's no doubt people take this way too far. They think there's some trick or magic they can play to make it deductible through their business. Again, it comes down to the simple question of what's ordinary and necessary to the business. And if it feels like I've said that too many times, just know that you're going to hear that a lot if you're sitting across from an IRS agent in an audit looking through your business expenses. Now, for a W-2 employee, where you don't own the business, you're not self-employed, you really can disregard all that. Even if you have expenses that sound like they should be deductible, if you're paying for professional dues, you're driving to client meetings from the office, you maintain a home office. These are items that would be deductible as a self-employed individual from business revenues, but unreimbursed employee expenses are not deductible under current tax law. They haven't been since 2018. The 2017 Tax Cuts and Jobs Act ended that for 2018, and the One Big Beautiful Bill continued that. So that's why sometimes people might tell you there was a benefit or that they're mistaken themselves. They don't realize that that's gone away for good. There's also a chance there's a few states that don't conform to that treatment and still get some benefit for your unreimbursed employee expenses. That benefit would be pretty small, but that would be only applicable in a very few number of states. Under federal law, no benefit to unreimbursed employee expenses. These were part of miscellaneous deductions. They also got rid of other miscellaneous expenses like your tax preparation fee, your brokerage or investment management fees, theft or casualty losses, and damages to personal property. Those are no longer deductible unless you're in a federally declared disaster zone. All these items you can disregard. And again, if you're not self-employed, you can disregard all those weird write-offs you hear people talking about. They're not applicable to you. And let's just focus on a few of the tax preferential items that are applicable to every taxpayer. Now, the key distinction on some of these items you'll note is a lot of them, you don't really do much to get them, and then others you really can influence quite a bit. So let's start with some of the new ones from the One Big Beautiful Bill. You have your no tax on tips and no tax on overtime. These are items, yeah, at the margin, you might try to pick up some more overtime income, but for the most part, you can't really influence that. But those will be above the line deductions, meaning reducing your income, regardless of whether you itemize your deductions or not. You also have the new senior deduction. If you're 65 years or older by 12/31/2025, you'll get an additional $6,000. Again, nothing you can do to influence that one other than being a certain age. The new vehicle interest deduction, that is an interesting one. That is one where behavior would influence it, whether you have the vehicle or not. But keep in mind, we're already in November here, so how much vehicle interest would you actually incur within calendar year 2025 that would influence 2025 if you buy a vehicle? Probably not going to happen. Other above-the-line deductions. An above-the-line deduction means you don't have to worry about whether you itemize or not. The other big ones to consider are your pre-tax retirement contributions and HSA, FSA contributions. The below-the-line deductions, meaning you need to itemize in order to benefit from these. This would include your state and local income tax deduction. This is another important change under the new tax law. From 2018 through 2024, taxpayers were capped at $10,000 of state and local tax deduction. Now they're capped at $40,000 as long as they're below $500,000 of income. So a lot more runway there with the state and local tax deduction. The big drivers there: property tax, income tax. Next, you have your mortgage interest deduction. This is only interest on up to $750,000 of total loan. You have your charitable giving, both cash and non-cash donations. You have large amounts of medical expenses, more than 7.5% of your income, then that also will contribute to your itemized deductions. Again, these are all below the line deductions, meaning you need to itemize in order to benefit. Your itemized deductions have to be greater than the standard deduction. That's all nonsense to you. Watch for my next video where we'll talk more in depth about these itemized deductions and strategies you can use to benefit. That is the Tax Talker for today. Hopefully we've simplified what you need to pay attention to as you approach year end. There's a whole lot of noise out there that you can disregard, especially if you're not self-employed. Rest assured, there's not some crazy hack out there for avoiding income tax unless you avoid income as well. Be sure to like, subscribe, drop me a comment, and stay tuned for the next video. We'll see you next time.